Describe the elements of the balance sheet: assets, liabilities, and equity. A company's balance sheet is also known as their statement of financial position or the statement of financial condition. It's a snapshot of their financial situation at a single point in time. What do they own? What do they owe? And what claim do the owners have at that point in time? And this ties in directly with the basic elements of a balance sheet: assets, liabilities, and equity. The makeup of any balance sheet follows this simple balance sheet equation. Assets are equal to liabilities plus equity. The resources owned by the company should equal how those resources were financed. Describe uses and limitations of the balance sheet in financial analysis. As we have said, the balance sheet represents a snapshot of the company's financial position at a single point in time, in terms of what they own, what they owe, and what claim the owners have. That kind of information is highly useful in determining that company's liquidity position, their solvency position, or their ability to distribute cash to the owners. It's a guide to the overall financial health of the company. Stepping away from those useful features, though, it's vitally important that you understand why the balance sheet is not a useful resource when it comes to measuring the company's intrinsic or market value. There are three major reasons for this. 1. Mixed valuation methods. Assets and liabilities throughout the document are going to be measured using varying methods of valuation. Some will be based on historical cost, some fair value, and the overall effect is that the amount reported will be the company's interpretation of the value of their assets, which is not necessarily a reflection of how the market values them. 2. The one distinct feature of a balance sheet is that it is reported at a single point in time, invariably at the end of the fiscal year. That means that even the reported value of assets, which are held at fair value, will only be accurate to the market if the report is released when those valuations apply. If the report is released sometime after market values are calculated, then they will more than likely be out of date. 3. And finally, we must not forget that there is a significant number of factors that impact a company's value, and not all of it is contained on the balance sheet. Their ability to generate earnings, to generate cash, their reputation in the industry, and their relationship with their customer base will all be factors that would be ignored if the balance sheet was the only source used for valuation. Describe alternative formats of balance sheet presentation. There are two presentation styles that a company can choose from when reporting the balance sheet: classified and liquidity based. The first method, classified, is simply where a company's accounts are separated into current and non-current assets and current and non-current liabilities. The basic idea is simply that the balance sheet is separated into sections full of similar items. With liquidity based, we move away from the current non-current breakdown and present the accounts in order of liquidity. We still have the distinction between assets, liabilities, and equity, but now, rather than classifying items in terms of their current or non-current nature, we order all accounts under their broader categories in terms of liquidity. Distinguish between current and non-current assets and current and non-current liabilities. Over the next couple of sections, we're going to be looking in detail at current and non-current assets and liabilities. In this LOS, we are asked simply to distinguish between these two major groups, but after that, we're going to go into some detail and look at example line items classified as assets and examples of items classified as liabilities. Okay, current assets. There are four basic defining characteristics that would lead us to classify an asset as current. Either we have an instrument held for trading, we have an item that is expected to be sold, we have an item that is expected to be used, or an item that somehow otherwise is expected to be converted into cash. Now with these last three, the expectation is always intended to mean either a year or one operating cycle, whichever is longer. Quickly as an aside here, what is an operating cycle? A single operating cycle is the time period from the purchase of goods or materials through the sale of the product and the collection of cash. It's the full lifetime of a product from its arrival in its most basic form into the company, through the sales process, down to the point where we actually receive in cash from the sale. Purchase plus sale plus cash collection. When it comes to non-current assets then, we simply need to understand that none of these apply. There are assets that are not quickly converted into cash or used within one operating cycle. These assets provide us with a great source of information about the company's investing activities. Moving on then, let's look at liabilities. In terms of current liabilities, we have another list of characteristics to look out for that would lead us to classify a liability as current. Again, any liabilities that are held for trading would be considered current. Anything expected to settle within a year or a single operating period would be considered current. And one other thing to consider there is that with any current liability, the entity should not have an unconditional right to defer into another period. If it's easy to push away into another period, then maybe we should not be classifying it as current. The final step then is to understand that non-current liabilities, just as we saw with non-current assets, simply means that none of these characteristics applicable to the current classification apply. If any of these are in place, then we have a current liability. If not, we can classify as non-current.